Investing in a company by analyzing it involves a systematic approach to assess its financial health, growth potential, and market position. Below is a step-by-step guide to analyzing a company for investment. 1. Understand the business industry and market position. Identify the sector the company operates in and its competitive advantages. Revenue model. Understand how the company generates income, products, services, etc. Growth potential. Assess the industry's future and the company's potential to grow. 2. Analyze financial statements. Income statement. Look at revenue, profit margins, and net income to evaluate profitability. Balance sheet. Assess assets, liabilities, and equity to determine financial stability. Cash flow statement. Examine cash inflows and outflows to understand liquidity and operational efficiency. Key metrics: revenue growth, year-over-year growth in sales, profit margins, gross, operating, and net margins. Debt-to-equity ratio measures leverage. Return on equity, ROE, indicates profitability relative to shareholder equity. Free cash flow, cash available after operating and capital expenses. 3. Evaluate management experience and track record. Assess the leadership team's history and their strategic vision. Shareholder alignment. Check if management holds significant shares, which may indicate alignment with investors' interests. 4. Examine market and competitive position. Market share. Evaluate how dominant the company is in its industry. Competitive advantage. Look for unique strengths, e.g., brand loyalty, patents, economies of scale. Barriers to entry. Assess how difficult it is for competitors to enter the market. 5. Assess valuation. Compare the company's stock price to its intrinsic value using price-to-earnings, PE, ratio, compares price to earnings per share, price-to-sales, PS, ratio, compares price to revenue per share, price-to-book, PB, ratio, compares price to book value per share. Discounted cash flow, DCF. Analysis, estimates future cash flows and discounts them to the present value. 6. Study industry trends and risks, macroeconomic factors, interest rates, inflation, and economic growth. Regulatory environment, laws and regulations that might impact operations. Competition and disruption, new entrants or technologies that could challenge the company. 7. Analyze dividends, if applicable. Dividend. Yield, the percentage of the stock price paid out as dividends. Dividend growth rate. The history and consistency of dividend increases. 8. Consider non-financial factors, sustainability and ESG factors, environmental, social, and governance aspects that could impact reputation and long-term performance. Company culture. Assess employee satisfaction and innovation. 9. Compare with peers. Analyze the company relative to its competitors to identify if it's undervalued or overvalued. 10. Decide based on your investment goals. Risk tolerance. Determine if the company's risk aligns with your comfort level. Investment horizon. Long-term growth versus short-term gains. Portfolio fit. Ensure diversification and alignment with your strategy. Tools and resources. Financial reports. 10K, 10Q filings. Analyst reports and stock screeners. Financial news and platforms. Bloomberg, Yahoo Finance, etc. Industry analysis reports. By following these steps, you can make an informed decision on whether to invest in a company. Let me know if you'd like help analyzing a specific company.